In the pantheon of the world's greatest investors and financial minds, you'll find Ray Dalio's picture hanging high in the rafters. The founder and former chief investment officer for Bridgewater Associates, one of the most successful hedge funds of all time, literally wrote the playbook for how to invest and generate alpha across asset classes and global economies. After 4 decades of delivering market-beating returns, Ray took that playbook and turned it into a New York Times best-selling series of books, including Principles, Life and Work, Principles for Dealing with the Changing World Order, and Principles for Navigating Big Debt Crisis. He turned that into a terrific educational video series and now an online course for financial professionals and family offices in partnership with the Wealth Management Institute of Singapore. A markets master, a historian, a philosopher, a philanthropist, and an educator. When Ray talks, we listen, and we are delighted to welcome Ray Dalio back aboard the Express. So good to see you again.
So great to be here again.
Thanks for being here. We love it. How, Ray, and we've gone through a lot over the last few weeks, a lot of things are starting to crystallize a little bit, but how has the election and the results changed your thinking, if at all, from an investor's perspective? Did you make any decisions going into this, or did you make any decisions coming out of it now that we know what we know?
Yeah, so you have to understand my perspective, so I'm going to lay the groundwork and then get to the specifics that's changed over the last few weeks. First of all, through my life, whenever I was surprised, I realized, and often it was because of the things never happened in my lifetime, but happened many times in history. So I think we're in that kind of an environment, the changing world order, the changes. We have to understand the changes. So for that reason, I studied these changes going back for a long time. There are 5 major forces. The first is the debt, money, market, economy force. Credit produces buying power. That buying power makes things go up, but it also produces debt, and there's a cycle, and we experience those cycles. That's number 1. Number 2 is the internal political and social order, the left, the right, capitalism, socialism, and so on. And that was where the election is, and we're going to turn to that in a second. Number 3 is the great world order, the change in the world order. We had a system coming out of 1945 in which the United States was the dominant power. The dollar's the dominant currency. They create a set of rules. How's the system going to work? The United Nations, the IMF, the World Trade Organization, that's all changing in important ways that has a big effect. The great powers conflict, what's going on with China, Russia, it has a bearing on everything that we're doing. Number 4 is through history, acts of nature. Droughts, floods, and pandemics have killed more people than wars and toppled more orders. So they cannot be ignored, and I don't think at this time can be ignored because of the fact that there's global warming, there's other things going on. And number 5 is technology, man's inventiveness of new technologies that makes productivity rise over a period of time. And there's nothing that's going to be more important than these new technologies. So we're going through a period of those 5 factors, I think, creating almost a time warp. And the world, I think, is going to be very different in the next 3 to 5 years as a result of those. They're interrelated. So you can't talk about one without understanding that interrelationship to me. So now we go back to the election. Okay. The real question on that election, going into that election, is would we have domestic order? How would that take place? If you had, let's say, a close election, particularly a close loss by Donald Trump, then there was a question. Would you have an orderly transition of power? Okay, risky situation. We have crossed that. We are past that. We have a mandate. Okay, the president has a mandate, the Senate, the House, and now the Supreme Court, and so on. So there's something new going on. What does that new thing look like? 2 things. If I was to take it domestically, it's reform. I'll talk about that in a second. Internationally, it's preparing for the war or the possibility of war with China, most importantly, and with other countries. Okay, now let's go into that for a second. Okay, that reformation is, it's a reformation of government and it's a reformation of the whole economy. It's going to be like Donald Trump in the administration is going to be like a corporate office. It's a capitalist reformation, and it has some of those fundamental values. That's going down to the nitty gritty. Okay. What does that mean for technology? Like we're going to have for 20% of our key chips have got to be produced in the United States by 2030. Okay. In order to do that, how do you do that? That's connected to an energy plan. That's connected. Okay. So there are a number of initiatives here. There's an immigration, there's tariffs, there's, many things that are initiative.
As the Department of Governmental Efficiency, all of a sudden, out of nowhere, to your point, that this is going to become much more like a corporation, we'll see what that ends up being.
Right. So I won't go through all the particulars because I'll just ramble too long. But instead, I want to say, okay, that there's that taking place. And then there will be things that are not taking place. And now you're seeing the prioritization of these things, which are the ones that are going to be, and what are those people particularly going to be like who get into that. And if you look at the type of people that are being there, these people are tough, committed to the mission, and they're hard asses. I mean, they're,
I think loyal is the word you hear a lot too.
Well, loyal, and also they're tough.
Yeah.
Like if you're making choices of this thing or that, there's no subtlety about that. So things like deregulation and the changes, that's what's going to happen domestically. And then internationally, self-sufficiency and a confrontation. So you're going to see fighters in that mission. Some things are going to go on the side. We don't have to talk about those. But anyway, that's what the picture looks like.
Right. We talked last when you came out with the principles for dealing with the changing world order. That book pretty much predicted the moment we're in right now. Even though we didn't get those results at that time, they're here today.
We have that world order today.
It is right here today. So I was going to ask you about your cycles principles. What cycle are we in now? You pretty much well described it, but how seriously, both as a functioning member of society, but also as somebody who puts money to work, do you take some of the campaign pledges? Do you take some of the policy promises when it comes to tariffs, when it comes to taxes, when it comes to deregulation, when it comes to government spending on things like deportation and defense?
I take those very seriously. I think that that's right. And then internationally, we have to recognize what that picture looks like too. I'm going to just touch on that, but on touching on the domestic, yes, I believe that this plan has been well in the works, that this for quite a time. And I think that they're going to be able to hit the ground running. And so we're going to see those changes. We're going to have now a time where aspirations and that inspiration is going to hit the realities. Okay, you might have to change laws. You know what it's like to change laws? You can't do everything. So we're going to see the prioritization of that, but there's going to be the need. You have to pay attention to the first 100 days, and then you must have these things accomplished in the first 2 years. So there's a priority question in terms of like, how good are they in actually pulling these things off? But those directions are real. Internationally, it's changed everything, okay? Because we've come from a world in 1945, the New World Order. The world ended in terms of that, and we had a system, multilateral organizations and all this. Now we have we don't have that system. We have an America First system, and you have a China First system, and so on. So there are no rules of the game. That is a power thing. So we're now it's tougher to have allies. You're going to have deals, but you're not going to have allies. And so different part of the world. We're paying attention now a lot to the United States. Of course, the United States is important, and we're Americans in here. But if you really want to understand the world, you have to understand how it's changing in a broader sense. What does it mean in India? What is the ASEAN countries going to be like? What is the Middle East like, the Gulf countries, and so on? That world is changing in a way that we shouldn't so singularly look at through an American lens.
Sure. Everything is connected, as we know. You do such a good job of pointing that out across all of your work, but we're also in this period of what feels like deglobalization, right? We used to kind of work together a little bit, supply chains. We've been pulling apart, getting more regional, getting tougher, and at a time where tensions are rising pretty much everywhere you look.
The way I actually find it is, geopolitically, you're in one of three categories. You're on the American ally side, you're on the Chinese and other side, or you're neutral. You don't want to get involved geopolitically. So we're going to have, for example, two totally different technology systems that are going to develop, an American version, a Chinese version, and so on. But in terms of globalization, I'm finding out like we're more globalized than in almost anything. Like everybody's together, same group of people doing deals. Okay.
Right.
They come from all different countries. Never before in my life was it like this. So you can find Saudis and Indonesians and Singaporeans and everybody. They're all in the same group. There's a group and they're all doing deals. And before it used to be much more, okay, here's Americans, and you wouldn't have Saudis or you wouldn't have doing the same kind of deals. They could be venture deals. They could be private equity deals. So this globalization of the economic part of it in terms of doing deals is very globalized. The understanding of people is more globalized. The education of a lot of people is more globalized. So both forces are at work.
Right. Yeah, people say we're getting more deglobalized, but as you say, money talks when it comes to deal making. I just came from a gathering of a bunch of global investors, big pension funds, big sovereign wealth funds. Everybody's looking to put money to work, but they're also looking to shore up their own interests because they can't predict the future either. They just know it's going to get a lot more complicated.
And they've never been together the way they were.
Right.
When you went to that meeting,
yeah,
and you're looking who's around, wow, it's like, wow, they never were together like this. And they didn't speak the same language, in terms of investing or anything. Yep. Now they all speak the same language. They're all looking at the same deals.
Yeah,
they're all saying, can we work together or can I outbid you? That's what it's like.
Sure. All you have to do is look at the floor of Madison Square Garden and you see it's sponsored by Abu Dhabi. And that might never have happened 5-10 years ago. But this is the way the world works today. Money is global and people are still wanting to put that money to work, even though geopolitical tensions probably have never been, except in wartime, as high as they are right now. Right.
That's right. So it's cool and it's risky.
Right. So let's talk about what this means for investors, especially individual retail investors, the folks that listen to Investopedia, the folks that read Principles, the folks that have been following you for years and coming to our website. We've heard this from a bunch of different banks, Goldman Sachs and others, about this expectation for curbing our enthusiasm for equity returns going out for the next decade or so. We've just come through pretty much 20 years of, except for the last couple of years, really low interest rates, really easy money, a government that had was not allowing any moral hazard to happen because they would step in no matter what, right? And this productivity of companies being able to generate massive profits to the point, Ray, where we have several companies worth over $3 trillion. Being a $1 trillion company is no big deal anymore. When you were starting out, we couldn't even imagine a $10 billion company. So what is this? How do you evaluate that call for more muted returns for the equity market, U.S. equities in particular?
My mantra of investing is 15 good uncorrelated return streams, risk balanced. Okay, so I want to start there, right? Okay, because I know that if I can pick good investments and they're uncorrelated investment, I won't lower my return because I'll have the average of those returns, but I will lower my risk by up to 80%. So my mantra is, what I don't know, what the risks are always out there. So that's when you first ask me a question, I think in that way. You have to and risk balance them. It's not necessarily dollar balance.
Sure, and it's not just these. It's this combination, this basket, the all-weather portfolio that you are well known for.
So now if I step back from that and I think about, the world now, so that's almost like 7.5% in things that are uncorrelated. There are some general themes, okay? My general theme would be, first of all, that we have a debt issue. Okay. And when I take that debt issue, most fundamental of all markets and the underpinning of every market is the treasury market. It affects everything. So in answer to your question, you have to start with the treasury market. And there's a supply-demand issue there in terms of this. And I've seen this before. One man's debts are another man's assets. When we talk about currency as a storehold of wealth, we're really talking, is debt a storehold of wealth? So when I look at that issue, I think we have a big issue that's there. It's a big risk. So as I start to make tactical deviations from, let's say, what is a totally balanced, assuming I don't know exactly what's going to happen. My biggest, most important deviation is I don't want to hold much debt as an asset. And I think the Japanese example is such a good example. It steals money quietly. And the way it does that is people make the mistake of paying too much attention to their nominal returns rather than their real returns, how inflation eats away at that. So, and when I look at Japan, what they did on average over the last 15 years or so is they have a 3% lower interest rate than we had in the United States, and they depreciated the currency by about 4% a year. So you're losing 7% a year in the value. It's depreciated holders of those bonds because of the monetization and all of that. I think that there's a significant risk that that will happen to us. So when I think about that balance, I think, okay, now, I don't want to concentrate any one bet on anything, but as I'm thinking about the bet, my biggest concern is that concern. Then when I get to individual stocks or anything, what are the risk premiums? What should I pay to be out of that?
Which is why debt and the treasury yields are important. That's where you're basing that.
That's right. And then so I think that there's a risk there. If you had normal times and you say, well, what is the inflation rate? And then give me what the bond rate should be. I would sort of say inflation currently is in the 2.5%, 3% vicinity. You should have a 2% real rate. So you come out in the 5-ish vicinity without the supply demand consideration. For those reasons, I'm concerned about rates. And I think people also pay a lot of attention to, is the Fed easing? And they think, rates will go down because of that.
Not exactly.
I've watched them go in two different directions for good reasons. Okay, so that's how I look at the Treasury market. Okay.
Well, back to that real quick. Are you watching Treasury yields rise because you think this debt deficit situation is becoming way too big of a problem? And if any of these policies go through that the Trump administration is promising, we're talking about several more $1 trillion of debt.
Yes, you have to sell it.
Right. Someone's got to want it.
Okay. The traditional buyers have been burnt in it and own too much. In other words, about 1/3 of all the debt is owned by foreigners, and they're owning it, and it's big parts of their portfolio. Sure. They've lost money in it. And besides losing money in it, issues like sanctions. Okay, think about the Chinese. Did the Chinese want the bonds?
Yeah, why would they buy our bonds if we're not buying their chips?
Japanese have had this problem, and so the portfolio is bigger. And then we've got not only the supply that is coming, a supply demand. So do they want to increase their market share? I don't think so in terms of the share of their portfolio. And then you put on that, that's just the new supply demand. The real issue, even beyond that new supply and demand, is if people think that that's not a good investment, you will get selling of existing debt. And if you sell existing debt and all of that debt, you can have a real disaster in the Treasury market. And so that would force the central bank in. What does the central bank do? They buy the debt, they print the money, and so on. And so that scenario exists as a realistic worry. So when I look at the markets, I say 15 good uncorrelated, but what would I want to have a tactical deviation from? I'm not really excited about the debt. Okay. Right. Then when I look at equities, I think I have to look at the specific equities. The idea of talking about equity markets as a whole is an obsolete idea because they're so different. And, we're now in an era of disruption. So what disruption means is bad for one, good for another, and so on, and how that's going to change. Of course, the hyperscalers and so on done well. I believe that really it's the most greatest advantages are going to be on those who use it well. Right. And we're not paying enough attention to that. We're thinking, okay, did they make the chips? Did they make that? Okay. But the users, because they're in a war that's going to be a very expensive war. It's a war that's so important to them that they don't. There's not a question of whether there's return on investment.
Right.
You have to win.
You have to win
okay.
market share,
yeah.
making chips.
or give that up.
And you see the bifurcation in the chip stocks that are doing well and the ones that are not doing
right.
well.
And you're seeing that also, which is interesting, is it's a national survival question. So what it means is it's more important than profits. It's more important than money. Okay. Which country? The country that has the best technology not only will have the best economics, but they're going to have the best military, the most. So these things are a war where profits can be a secondary consideration. But those that are benefiting from the technology and making transformations, like I think in investing, like I'm super excited because all of the times that my investing was, I would always write down my principles, my decision rules, convert them into algorithms, and I used expert systems to be able to build systems that would make decisions, computerized systems. I believe in that. Now, I'm very excited about what AI does in being able to do that. So I think that, and that's just only one area, but it exists in healthcare, exists in so many different areas. So finding those that are the beneficiaries versus those that are the detractors, the ones who are losing, but also getting away from really the superscalers and focusing on that, I think is important. I think location is very important. When I mean location, three basic things. When I look at countries, I look at companies the same way. Do you earn more than you spend? Do you have a good balance sheet? Do you have more assets than your liabilities? So are you financially good as a country? Good income statement, good balance sheet, because you're going to need that. Internal order. Is there a internal order that lends itself to productivity and so on, rather than fighting, including rich-poor fighting? Does capitalism exist in this environment, or is it going to be threatened? And number three is, are you in risk of an international war? It's so much better to be not in the war
Right.
than to be in the war, because history has shown, there's the war. There are the winners, there are losers, and there are neutral countries. The winners lose. They get deeper into debt and they have their losses. The losers are devastated. The neutral countries are the ones who are the real winners. So if you can have those financials so that you have that, if you can have property rights protections and working well together, and you don't have that international war. So when I'm looking around the world for my 15 good uncorrelated return streams, these are the things that I think about.
Right. Does crypto have a place in any of those today?
Yes. Well, I have a small percentage of my portfolio in crypto because what we're really thinking about is we have to think about what is the alternative money. Because a currency, is a medium of exchange. They will always be a medium of exchange, but it's a storehold of wealth. And so when you're talking about the bonds, the debt, okay, we have to think about an alternative money. And when we look at the United States and we look at other countries' currencies, they're all having problems, okay? So the same problems we're talking about in the United States are the same types of problems Europe has, same types of issues that China has. Am I going to own their debt safely and so on? And the same types of problems Japan has. So you tend to see them go up and down together. So you have to think about money. Money is, can I move it around? It's not like real estate that's knocked down and, right, nailed down, and then you also have it to taxes. So you're dealing with gold. And then you're dealing with the new version, which is crypto. Okay, so you have to think about that. I prefer gold. Okay, but that doesn't mean I'm into diversification. And so the reason I the reason I'm concerned about crypto is, first of all, privacy. The government knows exactly what you got, where it is, and it's also an effective way of taxing it. Because I was with central bankers when interest rates hit zero, a bunch of central bankers, and we're figuring out how negative can you make interest rates. The thing that limited the negative amount of interest rates was the paper. And so the answer to the question was, we can, for a very short period of time, have negative 400 basis points because of the fact that there's not enough storage space for all the paper. But they'll build storage space for the paper. And so
that sounds so 19th century.
But okay, now, if you don't have the paper and you have it digitally, you can have as negative. It's just the same as taxes.
Right.
So when I'm looking at that, I think, okay, that is not exempt from crypto. Okay, and then the reliability of crypto in terms of, let's say, saying, does it correlate with inflation? Does it correlate with those things? No, it doesn't really, not well. It's still largely a speculative vehicle. So for those, and number four is also, it's not likely to be a reserve for a currency. Okay, it won't work. Whereas now, as countries need things, what is the reserve? Gold is still, it's the third largest reserve currency, the US dollar, the euro, gold, and then Japanese yen. So I prefer gold, but anyway, whatever vehicle we're talking about, I think we're saying, I'm saying, you have to think about debt as being maybe you don't want one man's debts or another man's assets. You may not want the bonds. You do have to think of an alternative currency that's going to also allow your buying power. And a currency is something that can go from one country to another. It's, and so there aren't many.
Sounds like Bitcoin to me.
Mm-hmm.
And is the fact that it's become such a bigger asset in terms of the amount of assets under management, the amount of money that's into it, and it's been around now for over 10 years, that it maybe the thinking about it not being a store of wealth has changed a little bit.
Yeah, but I would say it still has to prove itself. So when you say it's big, it's a fraction of Microsoft, one stock.
Right.
Okay. Okay. It gets a lot of attention. I think there's merit to it. But you heard what I said in terms of the association.
Sure. What about the dollar? What do you think the direction will be for the dollar over the next 4 years? And then how does that play into the asset correlation that you're trying to build successfully? Because we know what high tariffs means usually for the dollar. What do you think?
I think that a lot is going to have to do with capital flows and the tightness of money, and whether the Federal Reserve, when the time comes, is going to be shifted more to control, which it certainly will be under Trump and the administration, which would favor a much easier monetary policy.
Yeah.
So there's certain things that are going on, which are while there's the tariffs, there's also the attraction for foreigners to come in terms of building businesses. And there's going to a lot of be business building. And in some cases, we don't have the national champions, even though there's a desire for the national champions. The idea will be, if they produce it here, that they are going to be welcome. So you might see more capital flow in. It's a tougher question in terms of monetary policy. And so also it goes down, what is it that's going to go up? So when we look at the euro, when we look at the yen, okay, there are real issues. Like the yen, we're really dealing with 300 basis points difference, and in both real rates and nominal rates, in terms of that tax that you have to pay in terms of the interest rate difference. So for those reasons, I don't think it's even the big question. I don't think it's the most important question. I think it's that all money will be at risk.
What is your feeling about the Fed being under more of the executive branch's control, more input, as President-elect Trump would like to have in terms of interest rates? Is that sacrosanct to you? Do you believe that the Fed should maintain its independence, or do you feel like it's never really been that independent?
No, I feel that it definitely should remain its independence. If I'm holding a bond and I want to know that it is certainly in the government's interest all the time to borrow and spend, particularly under your term, and then you let somebody else deal with the mess you created when they come to power. Okay, so that's always the case. So it undermines the storeholder wealth. I think the Fed should target a real bond yield of 2%, by and large. Okay, 2% is not too high, real, and it's not too low, and they should target that kind of a real bond yield, which you can see, by the way, in the inflation index bonds pricing. So I think that the cycles that we're going on from one extreme to another are very disruptive. But I think it's going to become a lot more political, particularly if there are problems, because the problems are going to be based on the Fed. And so it becomes political. And so I worry about that.
Yeah, this would be a new chapter in history if that actually comes to pass. All right, let's switch gears a little bit here. We talked earlier about Principles, the best-selling book series, a tremendous video series. Now you're taking it to the classroom, and you've partnered with the Wealth Management Institute of Singapore to do this. What's beyond the move of bringing it into an online learning platform? I've taken the class. I barely passed, because it takes a lot to get through it, but it's excellent. What brought you to that partnership?
I'm at a stage in my life where my goal is to pass along whatever I have that's of value, to some extent money, philanthropically, to some extent knowledge that I've done. And so it was great to be able to partner with them, and create this course, which is, it receives, very, very high ratings. People are learning it. That's transformative. So yeah, that's a great satisfaction.
And you're teaching people not just the principles for investing, but also for family offices. Your own family office has been in Singapore for over 30 years or so. What is it about Singapore, and why are you trying to extend this to the family office?
Well, I would say, what is it about Singapore? And what is it about all good places? Okay, it's basics. Raise your children well. The vast majority of the population can be well educated, not only in terms of skills, but also in civility. And that you come out in an environment that they can be productive. Singapore has no natural resources and so on. And all they have is human capital. And that how they deal with each other. You create a capital market, you create rule of law, you have people productive, and then they get the finances right. We were talking before about, do you spend more than you earn, and how you do that? Those are the fundamentals. Okay, so that's what, it's a very civil, and it's also a very exciting place because it's a window on that whole region. And that's a hot, interesting, transforming region.
As I said, I've taken the course. It's difficult, but if you paid attention to principles, the books, and the video series, and then all the lesson building in there, you will learn a ton from it. So I did as well. All right, switching back again. For new investors, people that are just coming into the market, or this is their first sort of experience with a new election shakeup and a new shifting of powers around Washington. Plus, it's a new day, and we have climate as yet another thing we have to factor into the way we think. How would you advise new investors who are approaching the market? Is it not enough to just be an index investor anymore and just ride the wave?
I think you have to approach it as a game, like a video game, like a life game. You approach it, though, with great humility. Okay, so you say, I'm going to go into the adventure, and I'm going to learn through experiences, and then I'm going to ask questions to Investopedia. When I did it, I started at 12. I did caddying, took my money, $50. Then I would put it in the market. I didn't know what I was doing. And my version of this, of Investopedia, is that when Fortune came out with the Fortune 500, they listed the Fortune 500. You could get the annual reports. I checked them all. I got all 500 of them and I would have my library and I'd ask the questions, and then I had my experiences. Loss is a great teacher. I have a principle: pain plus reflection equals progress. The learning comes from the pain and how you would change things. It was my greatest learning. My greatest loss was my greatest learning.
Right. People who know and have read your work and your biography know that you went through some serious losses. You didn't just wind up one of the most successful hedge fund investors in history. There was a lot of deep losses.
That's right. And when I had that created the learning. That's how I learned humility, how I want the smartest brains to challenge me and so on, to have triangulation. And I learned my mantra. My mantra is 15 good uncorrelated return streams. I learned that I could maintain the same return as any one of those investors with 80% reduction in risk. I wouldn't have learned that if I went through that. That was what created the bottom, and then from then on, it was pretty much straight up.
Plus, you document everything, though. You wrote everything down. You created a process because you weren't just throwing darts. You were studying your returns. You were studying the performance of things until you created a system that you could then, actually, you were early to AI before we were even talking about AI. You turned this all into an algorithm that captured your thinking and your recording, right?
AI has been in existence since 1956, and it has different versions. What they mean is, can it make a decision? Computers can make a decision. And what I learned at an early age, I'm in the markets, that I should write down my criteria for decision making. These are my principles for life, for everything else. Okay, don't just make a decision. write down your criteria. And then when you have your criteria, I could test my criteria through time. And I can make timeless and universal criteria so I know how they would behave. And I could put them into a portfolio that would allow me to understand what my game plan is. And with the computer being able to process a lot more information and complexity, like if I take positions, I want to know their correlations and all that. Can't do that in my mind. And also do it less emotionally. Because when you're sitting there with a trade that goes against you or whatever, the day of operating where, oh, I'm the smart guy and I'm doing it in your head is over. It's obsolete. So you have to move on to this, okay? And that's been my way of doing it. So yes, that's my way of doing it.
And also ways to teach other people to do it.
That's what
you've educated thousands of investors who have gone on to have very successful careers as well. So let's talk about what Investopedia was born with, our financial dictionary, our terms. You know that we are a site built on that. I know you have so many in your mind and over your career that you've developed, but do you have a favorite investing term right now, Ray?
Diversify.
I think you told me that 2 years ago and 4 years ago, and you know what? That is exactly...
Because it's the magic.
Yep.
That if you take equally good things that are not correlated, you improve the return to risk ratio. You reduce the risk. Because I think everybody should know that the risk of being wrong is the problem. And the world is filled with surprises. So there's no doubt that you need to do that well. Portfolio construction is more important even than the picking of the best thing you like.
Right. But this is educated diversification versus just, I'm just going to buy a bunch of things.
That's right.
To your point, they have to have either a no correlation so they don't hurt each other or give you an unrecoverable loss.
Yes, but there are two ways to look at that. There's alpha and there's beta, okay? Beta means, like, if I didn't know anything, what should I do? You still should properly diversify your risks in a way that allows that, and that's important. You also should diversify your alphas in terms of what your bets are. So diversification applies, in either way. Diversifying your betas is not that big, it's not a big deal. I mean, it's not as complicated as producing alpha, because alpha is a zero-sum game. And competing in the markets is more difficult than competing in the Olympics, because there's more money. Like if I was to say you want to compete in the Olympics, you'd say, well, how many people can? The markets, it's even more so, because there's so many people doing it and putting, I don't know how much, but is it $1 billion a year that we put into trying to get this right in terms of the computers and the brains and so on? Alpha is a difficult thing to produce. So humility is a beneficial thing. So you don't have to have the alpha necessarily. You do have to have the portfolio construction.
Right. And the desire to learn. And in your case, the desire to educate. You've educated so many investors and people throughout your career and through Principles, the book series, and now the class with the Wealth Management Institute. And you've been such a good friend to Investopedia, Ray Dalio. It's always a pleasure to have you here and on the Express. Thanks so much.
And you've been such a good friend to me.
Thank you.
Thank you. We're on the same mission. Thank you.
Thank you.